Welcome to Sophie Dottie's channel. Today we're going to decode one of the most famous, but let's be honest, most misunderstood indicators out there, the VIX. You've definitely heard it called the fear gauge, but what is it actually measuring? And more importantly, how can you use it to get a read on the market's mood? Let's get into it. You've probably heard this old Wall Street saying, when the VIX is high, it's time to buy. When the VIX is low, look out below. It's that classic contrarian idea, right? It tells you that the best moment to jump in is exactly when everyone else is running for the exits. It's a catchy line, but it brings up a really big question for any investor. Exactly. I mean, why would total panic in the market be a green light to start buying? To get to the bottom of that, we have to go way past the nickname and really understand what the VIX is telling us about what's coming down the road. So let's start with that famous nickname, the fear gauge. It's catchy, it's great shorthand, but it really only scratches the surface. To actually use it, we need to know what's really under the hood. Okay, so here's the official definition. The VIX is a real-time index showing the market's expectation of 30-day forward-looking volatility. Now let's unpack that. Real-time is simple, it's constantly changing. But the key words are forward-looking. This is so important. The VIX isn't about what happened last week or yesterday. It's a snapshot of what traders are betting will happen over the next month. It's a prediction, not a report card.
So how in the world does it actually come up with that prediction? Let's pop the hood and see how this thing is built.
First, you've got to get this difference. Historical volatility is like looking in your car's rearview mirror. It tells you how bumpy the road has been. The VIX, on the other hand, measures implied volatility. That's more like looking at the weather forecast for the road ahead. It's trying to predict how bumpy things are going to be. And that's its superpower. It's one of the only major indicators that is fundamentally trying to look into the future.
So where does this forecast come from? It's all based on the options market. Just think of options like insurance policies for the S&P 500. When traders get nervous, what do? They rush to buy that insurance, and that drives the price up. The VIX calculation scoops up the real-time prices of a whole bunch of these S&P 500 options, runs them through a pretty complex formula, and spits out a single number. So it's a direct reflection of how much real money is being spent to protect against big market moves.
All right, so we've got this number, but seeing a VIX at 15 or 25 or 40 doesn't really mean anything on its own. We need some context. Let's decode these levels and figure out what they're actually saying. Let's start with a really common VIX level, 20. You'll often hear this thrown around as the historical average, but what does it actually mean? What is it telling us? See, a VIX of 20 isn't just some abstract fear score. It actually translates into a specific mathematical expectation. It means that right now, the market is pricing in a potential move for the S&P 500 of about 5.8% up or down over the next 30 days. Pretty cool, right? It makes it a much more tangible tool for measuring risk. This little guide is super helpful. Down below 15, things are calm, maybe a little too calm. That's the look out below part of the saying, because low fear can mean people are getting complacent. The 15 to 20 range is kind of the sweet spot, a normal, stable market. Once you start climbing past 20, you can feel the uncertainty building. And above 30, well, that's pure fear and panic territory. But for a contrarian, that's the signal that maybe, just maybe, the selling is overdone, creating that potential opportunity. Okay, so we know what the numbers mean. Now let's look at the VIX's relationship with the S&P 500 itself. It's like this intricate dance they do. The main thing to know is what I call the seesaw effect. About 80% of the time, they move in opposite directions. The S&P 500 falls, fear goes up, and the VIX spikes. The market rallies, everyone chills out, and the VIX goes down. This super strong negative relationship is exactly why the VIX is seen as such a powerful hedging tool. But what about that other 20% of the time? This is where it gets really, really interesting. When they break the pattern and move together, it's not just random noise. These moments tell us something really unique about what's going on under the surface. Okay, case one. The S&P 500 is actually going up, but the VIX is climbing right along with it. What's that about? It means that even though prices are rising, traders are still buying insurance. This usually happens right before some huge all-or-nothing event, like a big Fed decision. The market is kind of hopeful, but also secretly terrified of a bad outcome. It's like nervous laughter. And then there's the flip side. The market is selling off, but the VIX is either falling or just staying flat. This is just as telling. It means there's no panic. The selling is seen as orderly, maybe even healthy, a pullback that was needed. People aren't scrambling for protection because they think the dip will get bought up pretty quickly. It shows a ton of underlying confidence, even in a downturn.
And this right here shows you why we call it a crisis barometer. I mean, just look at these numbers. During the 2008 crash and the COVID crash, the VIX exploded to over 80. That's not just high, that is absolute sheer panic across the entire financial system. The VIX perfectly captured those moments of maximum fear, which, with hindsight, also turned out to be moments of maximum opportunity.
Okay, we've defined it, we've decoded it, we've seen it dance with the market. Now for the big question. How can we, as investors, actually use this thing? How do we turn this indicator into real, actionable insight?
Well, here are the main ways. First, it's your real-time risk barometer. It tells you when to be careful. It's also a great tool for managing your own emotions. Knowing that a VIX of 50 represents extreme panic can help stop you from selling at the absolute worst time. It signals those big shifts from risk on to risk off, helps you spot potential tops when it's super low, and like we've said, helps you sniff out potential bottoms when it's screaming high.
You can also use it to think about asset allocation. When the VIX is spiking, that's a classic risk-off signal. Might be a good time to dial back your stocks and add some safer stuff like bonds. On the flip side, when the VIX is really low, that's a risk-on green light for stocks. But here's the pro move. A savvy investor might actually use that low VIX time to buy some portfolio protection on the cheap, getting ready for when things eventually get rocky again.
This all leads to one final, really practical idea. A VIX of, say, 25 feels totally different today than it would have during the COVID pandemic, right? So how do we know if the VIX is actually high or low relative to the current environment? Well, a lot of traders use something called VIX rank. It's super simple, but really smart. It just takes the current VIX level and shows you where it is compared to its range over the past year. So a VIX rank of 90% means that volatility is higher right now than it's been for 90% of the last 52 weeks. It gives you instant context. And here's how you use it. Volatility loves to return to its average, so a high VIX rank, over 50%, suggests things are stretched and volatility is probably going to come back down. Some traders use that to bet on things getting calmer. A low VIX rank, below 20%, suggests the opposite. It's unusually quiet and volatility might be ready to wake up. That's the perfect time to buy some protection when it's still cheap. And that brings us right back to where we started. The VIX is this incredible window into the market's mind. It shows you exactly how scared or how greedy the crowd is at any given moment. But it's not a crystal ball. All it does is present you with a choice. Do you go with the flow, or do you use their fear as your opportunity? And for a lot of us, figuring out that choice, well, that's what investing is all about.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.